Hello and welcome to my channel Happy Hours. In the last video I discussed about the base effect, GVA, gross value added, and the potential GDP, its determinants and the constraints factors. Today I am going to discuss about the public finance and government receipts, the revenue receipts, taxes. So let us proceed with the first topic, which is the public finance. The government finance is the public finance. The following are the important topics of its area. First is the government receipts, second government expenditure, third is the government deficit, and the fourth and the last one is federal financial issues like the finance commission, etc. The very first topic is government receipts. They are divided again into two parts. First is revenue receipts and the second one is capital receipts. Now we should know what is the revenue receipts. The receipts for which the public assets are not required to be reduced and the public liabilities are not going to be increased. These are known as the revenue receipts. Now we should know what is the public asset. We all know the public asset is the government properties. On the basis of the source of income, we are dividing the income into two parts. The first is the good and the other one is bad. The bad income are those under which the criminal activities are indulged, arms smuggling, kidnapping or human trafficking, such things are being done. The source of this is known as bad. The next one is the good income, which is the honest income. The income earned by hard work. The professional, agricultural, etc. adjectives are added to income to show the source. Now we should know what is the asset. Asset is the property of the public. Now we should know what is a liability. The financial commitment, we need to return money if can be of two types. One, when we take loans from other, and the second, if anybody is depositing money with us. This is also known as liability, as we have to return it to them. This is deposit but not loan, such as Sukanya Samriddhi, post office deposit schemes, etc. RBI is the manager of government borrowings. Government takes loans from the RBI. This is known as borrowing. Now, whenever money is coming, we call it as receipt. And if the money is going, that is known as expenditure. Now, when the money is being borrowed, then the liabilities are increasing. So, such money is not the revenue receipts. First, then we should know what is deposit. Small saving schemes which are directly under the control of Government of India, such as Sukanya Samriddhi Yojana, post office deposit, especially in the rural areas, because every rural area is not having a bank, but they can have the post office. An important fact is that if we deposit money in bank, there is no guarantee. The guarantee is limited up to 5 lakhs only. Such limitations are not there at the post office. That's why the post office are more reliable. That is the cause why post office are more attractive options also for the rural public. The other fact is that the rate of interest in the post office is comparatively very high in compared to the bank. So it is the kind of deposit. It's not kind of liability, because these are going to be returned to the public again. There are government in providing a service to the people. Constitution says that the liabilities in the form of deposits should be deposited in the public account fund, not in the consolidated fund of India. Now, let us understand the revenue receipts. The revenue receipts are further divided into two parts. First is the tax receipt, tax revenue. The receipts from all the direct and indirect taxes. Tax is a compulsory unilateral payment to the state, for which the state is not required to provide any good or service. Neither the tax is returned by the government. Today's taxes are not tomorrow's liability, and tax evasion is a crime. Punishment and fines are applicable to such people. Due to increased size of economy of the the government is not able to control or bind the people to return the tax. Many reasons are there also, like dishonesty, intelligence, lack of intelligence, hard work, etc. also are the reason behind of not getting good tax revenues. Next, we should know what are the non-tax revenues. There are five non-tax revenues. First is fees, then fine, then interest, then dividend and profit, then the external grants. Now discuss one by one. First is the fees. It is bilateral. For example, if somebody is paying the fees for a competition, then there is a service provided to that person in the form of getting a reserved seat, permission letter, and other related facilities. Fees is again optional. The conditions are applied. This is not a liability since they are providing a service. Then we should know what is a fine. Fine, as we know that whenever you are going to mm, break the rules, you are going to we have fine. This is pure collection of government, and it will be the net income for the government. Then the next one is interest. Whenever you are borrowing a loan, the bank is giving a interest, taking an interest on that. Loan to states, other countries with interest. Asset is not getting impacted by this. The principal amount is also not getting impacted. It is not a liability on the government, but for the one who is taking the loan. Next and very important thing is the dividend and the profit. This is the largest component of the government of India, non-tax revenue income presently. The RBI provides largest amount of the profit to the government of India. Because the profits never reduce the assets, they are not the liability also. Like the last final thing is the external grants. There are also unilateral payment like subsidies. The grant amount are never returned, and the provisional government cannot give grant to the union government. So fund cannot flow from the lower to the higher. So basically the external grant is from the other countries to the country. Now we should know what is the direct and the indirect taxes. Direct taxes are such taxes whose burden cannot be transferred on others. These taxes are mostly imposed on income, assets, and transactions of assets. The following are the important examples. The first one is income tax. When somebody is buying an asset, like buying a house, then the buyer has to pay stamp duty on the time of registration, and this is a kind of direct tax. Similarly, the seller is giving a capital gain tax, which is the difference in between the buy and sell of the product, to be imposed by the central government on the non-agricultural income of the people. It is also called the PIT, whereas PIT means personal income tax. In India, agricultural income is not under the taxes, and it is the topic of conflict as non-farmers are taking the profit of it. Some people are deliberately buying the land to avoid the income tax. So the farmers are not the basic beneficiary of this law. Now the next one is the corporate tax. A tax to be imposed by the central government on the profits of corporates. This is also known as CIT, corporate income tax. The next one is the capital gains tax, which we have already discussed. The tax to be imposed by the central on the capital gains. When the buyer is selling his house to a new person, then the capital gain, these are known as on this you are going to give a tax. Capital gains are income from the sale of assets like equities, bonds, houses, etc. Like suppose you have bought 100 units, and then you are going to after a year you are going to sell the same 100 units. Suppose the first price was 100 for each unit, but after 10 years the price if you are going to resell it, and the price of each unit is increment by 20 rupees. So the next income will be 20 to 120 for each unit. And now the units are going to there will be a profit. and on that profit you are going to give the capital gain tax. Next one is the land revenue, a tax to be imposed by the state government on the land holdings, and it is very lump sum tax. It is not on the farmers and very less. It is not a proportional type of tax. So these are not exploitation on anyone. Now the next one is a profession tax, a lump sum tax to be imposed by the state government on the various professions like doctors, chartered accountant, advocates, and so on. Next and the last one is the property tax, which is very famous, a lump sum tax to be imposed by the local bodies on the residential and commercial properties or buildings. It is again not proportional. Now we are going to proceed to the next one is the indirect taxes. The taxes are those taxes whose burden cannot be transferred on others. These taxes are going to be burden on others. These taxes are imposed on the transactions of goods and services, and the very famous is the GST. Out of direct and indirect taxes, the direct taxes are considered to be better because of the following two important reasons. The first one is the direct taxes can be made progressive while the indirect taxes are inherently regressive, creating a higher proportional burden for the lower income people as compared to the higher income people. Next, we are having the second important fact, and that is the direct taxes do not impact prices of goods, while the indirect taxes do so, resulting in the change in the public choice and the welfare. With this, I am going to conclude. Thank you.